Into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Anirban, welcome back to the Australian Investors Podcast, mate.
Thanks for having me, Owen.
Today we're going to be talking about just a bit of what's going on in the economy, catching up. We'll talk about how to value tech stocks, which is really interesting because you've written a lot about this recently. And we're going to share a bit of our screen with listeners and viewers. So if you are on YouTube, you can jump on and you can have a look at what I'm showing Anirban, particularly here at the start. I'm going to share my screen just to kick things off, mate. I thought I'd share my screen, and I've put together 4 companies, right? I'm going to assume that you can see this. I'll try to zoom in a bit. Mm-hmm. And these 4 companies, there are 2 tech stocks and there are 2 other companies, 2 industrial companies, let's say. I've got 2 US side by side. That's the first one here. And then I've got 2 Aussie small caps. So I'm hoping you can identify a bit of a guess who, which one is the tech stock amongst the 2 here from the US. And so for those people that are listening, not viewing, we can see one company on the left-hand side has pretty, strong revenue growth over the last 3 years. One on the other side also has pretty strong revenue growth, but over maybe 5 years, seems to have less earning down the bottom line. Which one do you reckon switch, mate?
Well, like the left-hand side looks like a tech stock. I think I probably even might know the company, I'm guessing, but I'm never be sure. I mean, the gross profits are pretty high and they're rapidly increasing in at least the left-hand side. From what I can see, I'm trying to see. I can't really see the right-hand side that well, and there's a fair bit of.
I'll zoom in.
There's a fair bit of dilution happening in the total number of, the weighted average diluted number of shares, fully diluted number of shares. So that would almost suggest that, that's the case. Now, the other one on the right-hand side. I
tried to pick 2 companies that didn't have colors in their financial statements, so it didn't give anything away. But I've got a bit of red in this one. So on the one hand, you said the one that had rapidly rising gross profits and more dilution. And then the other side is this one here, which is it's got some net debt, although it's been coming down by the looks of it. It's got some CapEx figures down the bottom.
Yeah. So is that billion or million? They're million.
This is millions. Yep. So we've
so
got $92 billion of revenue in 2020.
Yeah, I mean, I might even have a guess of what that company might be. There's a fair bit of capital expenditure there, right? And it's got earnings per share, but it's got cash dividends there too. Okay. Interesting.
Okay.
So 92 billion. Okay, I might not have a good idea of which one that one might be, but that looks more like an industrial. But I don't know.
And what makes you think that?
Well, the cost of sales seems pretty high, right? Relative to, so the COGS are pretty high, so the gross profits are smaller, if I can tell, right? So that's one of the. It's not as asset light as it would seem. At least that's what I can gather from looking at the one on the right hand side. Right, whereas the one on the left-hand side seems to be asset light. So that's one, definitely telltale sign. Typically, the other thing is that there's a lot of capex. Tech companies also have capex. The total assets, like that's rapidly increasing on the right-hand on the one on the right-hand side, right? I mean, you have 51 billion of capex. That's like a capital-heavy business signature. So if I had to say, I would say that the one on the right-hand side is is a capex heavy business, whereas the one on the right hand side is not. One on the left hand side is not. One on the right hand side is. But that's my guess.
Yep. Okay, so you're guessing left-hand side is tech stock. Some of the things that we've noticed, like shares going up, number of shares outstanding, really wide gross profit margins, but increasing. It also says subscription under revenue. And then the other one we see $92 billion of sales, but $66 billion cost of sales. So the net earnings figure down below is much smaller relative to revenue, and it's got total assets increasing. So ding, 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 you are correct, mate. Would you care to guess, just take a stab in the dark, one of these companies you know pretty well? I think both of the companies you know, generally speaking, but one of them you know pretty well. Which one would you be brave enough to guess which company?
So maybe the left hand side, I'm not 100% sure, but the left hand side could be Cloudflare as an example, maybe. I'm guessing. It's kind of hard to tell because a lot of those companies have similar numbers around this time. Right hand side, I'm not really sure what that company is. Is it? If you give me a hint, is it industrial?
I'd say consumer staples, consumer discretionary.
Okay. Consumer discretionary. Not really sure. I was going to say Nike, but it seems a bit low for Nike's revenue.
Okay. The red color might give it away for the brand. So it's a red, there's some red font in there. It's a big brand, global brand. Okay, I'll save you the pain. It's Target. That's Target's accounts right there.
Okay.
And you were very close. You're very close with the other one. The other one isn't Cloudflare, but it's Okta. So the cybersecurity business, which we've talked about before, which is very similar. And in the US, they obviously give nothing away with the standard financial statements. It's all black and white or blue and white. But yeah, like this is actually an idea from Joe Mager to try and do something like this in a podcast where we could put two sets of financials side by side and see how we go. Now, the next one, to bring it back home to Australia, is probably going to be harder. So what I've done here is I've got ugly financials. No, there's nothing pretty about these. But here we can see two different companies, and I'll see if I can fit them both on the screen for you. Yes. One is an industrial company, and one is a tech stock. But these are small caps. So we've gone not only to Australia, where it's slightly different reporting, but also down the market cap spectrum. So just to summarize for people that are listening while you take a look at these, we can see here one company on the left is reporting a loss. The loss has narrowed from $4 million to $900,000. That's the company on the left. It's got seems to have pretty wide gross profit margins. And on the right-hand side, we've got a company that has a list of expenses. It doesn't really break out cost of goods sold, or it does, but it's under the expenses item. It's a huge cost of goods sold. It's got a lot more revenue, $461 million versus 25 for the wide gross profit. It's actually making a profit, but if we look at the profits, it seems like there may be a few other things in the mix here of why profits may have eventuated this year. So what do you think?
Well, this one again, it's like left-hand side seems to be a technology company, or seems like has a tech flavor. The other one, definitely cost of goods sold being high, basically means that you're making some physical product, something physical. You're not just selling bits and bytes, which have incremental zero cost. So it looks like I'd say that one on the right is industrial or some capex heavy company. One on the left is not. In terms of other costs. You could see the scaling as well. That the left hand side is scaling. Right hand side. Well, right hand side is also scaling. But
yeah, it's interesting, this set of financials, don't you think?
Yeah.
Like, we've seen a massive increase in revenue from 158 million to 461 million year over year. And we can see the cost of goods sold going up nearly 3x as well. So basically every cost has gone up nearly 3x in 1 year.
Yeah. If I had to hazard a guess, is it like they have, occupancy costs and things like that. Is this like some sort of building leasing company or some some company that's making some sort of rent income? I don't know. But again, that would seem like the cost of goods sold seems still pretty high. So I don't know. Maybe it's making something. I have no idea.
Yes. So you're right. It's so this company, you were right again with your guesses, being that this one's the industrial company and the other one here is the tech company that's scaling. It, like just on the surface, it looks like slower, but it's actually scaling more sustainably by the looks of it. The one on the right is National Tyre and Wheel. It trades under the ASX ticker symbol NTD, and it's
Okay.
a wheel and tire distributor in Australia. It's the biggest independent. And the reason why its revenue exploded like this is made an acquisition of a
Right.
company that was bigger than it. And you can see there's a lot of unusual costs in here, like professional fees and acquisition costs went up to 3.5 million. You can see employee expenses and other costs went up to 58 million from 17, and there's a lot of depreciation in there. And on the other side, this company is actually Alcidion, the technology, like it's a software company that does health tech. So it offers something called Maya Precision, which is installed in hospitals and out of hospital to track patient flow, to do clinical decision support. So that's this company. It's fallen, I think, 70% over the past year when I pulled the numbers as at the date of this recording. So those are the two companies. You got them right, mate. And I think this will kind of, I guess, help us lead into the next topic of conversation, which is basically how to value tech stocks. So one of the things that's going on in the market at the moment is tech stocks have been swamped. And for an investor like me, I don't necessarily see that as a negative. I mean, I don't like to see portfolios fall, but as a long-term accumulator, I feel like this is actually an interesting time because now I can suddenly potentially buy companies that I've always wanted to own at cheaper valuations. I don't know. Maybe I'm wrong. Maybe I'm too early. It's hard to know whether you're right or early, or wrong or early. What do you think?
Yeah, I think that's sort of the right. That's my approach. I wouldn't say it's the right approach. I think if you're a long-term investor, then cheaper stock prices, share prices, mean you can own more of those businesses that you like. And if you're not looking to sell in the near term, if your holding period is like a decade or more, then yeah, that's certainly an interesting time to valuation like when you said Alcidion's share price has contracted by 70%. I mean, there are so many companies whose share prices have contracted by 70%, 80% from all-time highs. So yeah, like I mean, it's very hard watching your portfolio shrink by by half. But at the same time, if you are regularly investing into the market, it's definitely an advantage, right? I mean, you can ignore the loss that you have. It's not a realized loss in that sense, right? It's
Mm.
yeah, yeah,
Mm.
yeah.
And I think for it's almost, when CEOs or CFOs say it's a tale of two halves or a tale of two quarters. It's a one they say that so often during COVID. It almost seems like that it's a tale of two different investors or two different sectors. It's like there's tech stocks or growth stocks, and then there's everything else. Everything has been a little bit punished, but tech stocks in particular and those high quality stocks that had those rich valuations, they've all been binned. Even if they're growing, a lot of the times they're still, like some of the companies that I follow are still growing. Fundamentally, they're growing, but their shares are still falling. They might have one good day and then they fall. But I guess that plays into this whole idea around sentiment as well. We see, consumer confidence. I'll just bring this up for those people that are watching real quick. This is US consumer confidence. It's at, I think it's at a 10-year low or 20-year low or something like this. You can see I've got the Michigan Consumer Sentiment chart here, and you can see it since on Trading Economics, since it was reported, it's basically at the lowest point. So there's that. In Australia, we've got, I think it's near COVID lows. So consumer confidence is trending sharply down. For me, mate, I mean, I'm not an economist. I just track these things out of interest more than anything. For me, if consumer confidence is so low and going lower, it would seem to me that if you're trying to control inflation, that well, you're doing your job basically because consumers aren't confident, so they're not going to be spending as much. Maybe I'm wrong, but that's kind of the feel that I get.
Yeah, I think that's a very reasonable, that's a very reasonable assessment, right? Like, I mean, what the central banks, I think, are doing, they're doing two things. Like, A, they realize that inflation is high, so they have to, push the brakes, so to speak. And one way to do that is to raise interest rates, right? And these flurry of like high, like 0.5 and 0.75 type of increases, they're there to sort of apply that brake, right? And it's very similar, like whether you look at the US or Australia. I mean, when the interest rate goes up in the US, it doesn't directly impact the mortgage market, but it indirectly impacts the mortgage market in the sense that those people who have mortgages, their rates don't go up, but new mortgages are more expensive, which then has impact on building approvals, which then has impact on demand for building goods, and which then has impact for other things like new white goods and things like that. So there's a flow-on effect. So that's already starting to happen, and maybe this tough talk on interest rate rises is meant to curb consumer spending. But the other, one of the things like I like talking about is a lot of the stuff that we're thinking and looking at is backward looking, right? So you put out Target, and I like to use Target as an example. Target's inventory was about $15 billion last quarter. It was up 40% year over year. Walmart's inventory was like 60 billion and it was up like 35%. These companies' inventories do not increase at that magnitude, right? Excuse me. Target inventory is like plus 3%, minus 3% every year, right?
Yeah.
So that's very odd. And I think a lot of things, this is something that Tim Cook has talked about. When he was asked about, where is the shortage, and he was talking from a technology point of view, he was saying, well, the shortages are in the old nodes. What that means is, and his nodes definition is basically older chips. One would think there should not be any shortage in the older chips, right? But what he was saying is what has happened is that a lot of hoarding has happened. Initially when COVID happened, a lot of orders were cut. But because of stimulus and people staying home, the buying patterns changed. Then a lot of orders started coming through. And then people said, oh, we cut orders. Now we need to really make up for it. So they over-ordered. And that sort of continued for a while because, with the lockdowns, I think the basic, like distributed systems are very good at carrying signals. But when the distributed systems signal carrying mechanism is tempered with, you sort of get out of equilibrium. So that's basically happened, right? So we had lockdowns in the West and lockdowns in the East, and now we have lockdowns still in China and various other parts. So the basic signaling mechanism is kind of distorted, which means that signals do not propagate properly. So to use Target as an example, Target has an excess of white goods, it's excess of outdoor furniture, it's got a lot of TVs, which they will probably have to discount, in July. And other companies are, have said the same thing, whether it's Walmart. So there's a lot of discounting going to happen, which will have an impact on forward orders. That should in turn result in some smoothing of ocean freight and things like that. Right. I think the big wild card, in my opinion, is still the lockdowns in China and the strict COVID zero policies in China. That has an impact on not just consumer spending there, but it has other impacts like, for example, no tourists from China coming. It has impacts such as, their productions being curtailed and things like that. So, as I said, I think we are still in a distorted economy. But, so consumers haven't been down. I think the rates and everything else are doing its work. And I think hopefully they'll work through the system in due course.
Actually, it's interesting because a lot of companies, Danielle Ekuye on Twitter made this point yesterday, which is that a lot of companies have excess inventory right now. They've banked on last year being this year, and it hasn't been the case. And we saw BWX, which is a serial acquirer of beauty products and what have you. It fell 70% yesterday on the ASX for a myriad of reasons, but that's an example of a company that has a lot of inventory on its balance sheet. And it's interesting, though, that, because even Woolworths here in Australia has come out and said, we're going to cap prices on some consumer staples, which means they're going to eat the margin, basically. So, yeah, I guess this is just a whole way of thinking. Like, for me, at least, I always try and have a bent towards optimism when I invest, because that's kind of like the default stance, I think, if you're a long-term investor. And for an investor who's looking at companies that were the market darlings and are still extremely high quality, now I'm thinking, okay, well, how do I value these businesses? And maybe that's something we can talk to now, mate. Is like, I know you penned an article. I'll just share the screen for those that are watching live. It's called on the hidden profitability of software companies, and you use some examples. We've talked about dollar-based net retention on the show before and underlying profitability. I tuned into a kind of webinar the other week, and one of the investors there is a traditional value investor in the sense that he's just looking for the asset growth. So he's looking for balance sheet items. He's looking for net assets to go higher. He's excluding intangible assets, so on and so forth. And he did mention that maybe technology companies require a different lens. And I would highly agree with that. You made the point before that basically you've got, two totally different companies. When you look at the financials, why wouldn't it be the case that you use two different strategies or methods for analyzing those companies, right?
Mm-hmm.
And so riff on this for a little while is basically, how can investors think about this, in your opinion?
Yeah, so like one way to think about it is so when you think about subscription businesses, a subscription business basically means that you are selling a product and it's a recurring revenue stream that you're going to get over a period of time, as long as they haven't canceled the product, right?
Mm-hmm.
Many companies in the software as a service space also have the slogan called land and expand, and what that really means is that you try to find a customer using a product, but then you have multiple products in your suite. So once you've landed a customer, they're happy with one of the products that you have been able to sell them, then you can sell them more, which is an expansion. Now, expansion doesn't necessarily have to happen with products. It can also happen using more seats. So for example, if you sell like 100 licenses to a company, basically you might you might have been able to sell the software to, say, the IT team, maybe the business management team, or the HR team of the same company could also utilize the same software. So that's more seats, right?
Mm.
Then there's a third dynamic that can come into play. Some companies charge based on usage. So one way to expand again is that if you're charging based on usage, which could be like more CPU, more storage, more writes, more reads, more containers, whatever you want to think about it. This is going more heavily into sort of technology landscape. More IT and DevOps space. In that case, then and data analytics space, for example. In that case, then once your people start using your software and they find value, they might use it more, right? And therefore, on a usage-based thing, you can have more usage. So the idea of land and expand is that your same customer, if a customer base was, say, generating you $100 of revenue last year, if they can generate you $120 of revenue this year, then that's an expansion of 20%, or dollar-based net retention, as they like to call it, of 120%. So what I like about this particular metric is there's an exponential nature to this, right? So if you can generate 20% more from that customer base, and you can continue to do that over long periods of time, that basically shows two things: A, that people love your products; B, that you are very good at innovating; and C, that your product is becoming more and more sticky with your customer. There's become more and more ingrained in their day-to-day usage. So all of those things are actually pretty good. There's going to be high switching costs for this sort of product. So now one way to think about this is as a backtracking, there's another metric that companies report, which is, I think, underutilized, which is known as the remaining performance obligation, right? This is basically the number of, or this is the dollar value of contracts that you have signed that are going to be recognized in the future, right? So sometimes what happens is companies will sign deals that are long-term, say 3-year contracts, 2-year contracts, maybe 5-year contracts, in order to get maybe a bit of a discount, and they have committed to spend this much with you. So that in my mind, it shows, if you think qualitatively, it tells you commitment. Right? Committed contracts means commitment. If you're making like a $500,000 commitment, you're really committed to that relationship. Those revenue then, as they use it, are going to be, so that RPO, or remaining performance obligation, is going to turn into revenue, right? So in a way, the expansion and the selling is done ahead of time. So your sales marketing team have done the sales. That's showing up in the RPO, but you're not recognizing it, and it's not showing up in revenue yet, right? So one lens to look at is just from a retention point of view. So if you say, like, this particular company, say Cloudflare, it reported revenue retention of like 127%. That means it generated 27% more this quarter than it did in the past year, from the cohort of customers that it retained, right? So that is showing up in your revenue. And one way to think about it is that if you think about the sales and marketing team as two components, one that is responsible for landing new deals, another that's responsible for expanding new deals. Effectively, if you just exclude the landing component, because the lands are typically showing up in the remaining performance obligation, right? They're going to show up in the future. Then you would see that, well, this company is actually quite profitable because you remove the cost for landing new deals. And then you'd see that this company is growing at 27% and it's probably profitable on an operating basis at around 25%. Right? Now, of course, you can argue that if I don't land any customers, then I will not be able to expand, which is true. But remember, as the base of these companies are growing, like companies like Cloudflare that I've used as an example, it's not that their expansion rates have decreased, which basically points to the innovation, right? If you're innovating fast enough and landing more customers, then you're able to sell that same customer base a lot more, even at a larger scale, right? So that's one way to look at, the hidden profitability of the company. So they're not profitable. Many companies are not profitable by design because they're sort of trying to get those committed contracts locked in. They're trying to build the product, and they're trying to, just go after greenfield. The final thing that I think a lot of investors miss with software, and I'll stop after that, is, the thing that people think about is, well, if you are replacing someone, then somebody's going to replace you. But most of the time, what's actually happening is they are not replacing. They're not what I would call rip and replace, right? They're more greenfield opportunities, right? So if you use Okta as an example, so Okta is not replacing anything really, right? Okta is basically providing a new form of identity and security management and login management for people. They're not really replacing anything as such, right? Or it's replacing very cumbersome old tools of providing security. That's what it is replacing, right? Or like Xero as an example, right? Xero is not replacing another software typically. It's basically replacing the spreadsheet, right? So often, greenfield opportunities that they have, and then really the retention rate is an example of innovation and how quickly. The counterpoint I'll make is that if a company is a software company, is a SaaS company, enterprise software company, and it does not report retention metrics, that's something going on there, because that's one of the most important metrics. Like, those are companies that tend not to invest in, because then, well, if you're not telling me an important metric, that means, there's something, maybe it's not good, it's not good enough, maybe, it's something is being hidden underneath it. And so that's how I think about it.
Yeah, there are so many points and perspectives around that, but I think you've summarized something that I was going to talk to, which is that basically how we value companies, if we're looking at tech companies, is that typically in the past we would use discounted cash flow analysis. For example, if we're looking at Target, which we've got here, you could easily, just from the set of financial statements, just like income statement or cash flow statement, remove capex or any leases that you want to remove, and you could get a rough estimate, provided you were okay with the working capital, of free cash flow. You could just go, yep, that's free cash flow. It's what I've been taught at school, what have you. But it seems to me that a lot of investors really, or analysts too, not just everyday investors, haven't really caught on to this, which is surprising to me, that what you see on an income statement is what the company gives you. It doesn't necessarily reflect the true economics of a business. And right. For those people that are watching, I've got my old Xero discounted cash flow analysis here, and there are many shortcomings to discounted cash flow analysis. I'm fully aware of those. But one of the things that I kind of grasped at, which before I really knew what dollar-based net retention was or how powerful it was basically just looked at the financials and said, well, how much of this is spent acquiring new customers? How much of it be thrown out if they chose to? And what would the profitability be like? And if you looked at just the earnings of Xero, you would say it's not very profitable, and it's never going to be profitable if it keeps this up. But I think the insight here came from recognizing on the income statement, well, maybe some of that sales and marketing isn't necessary. Maybe it's more variable than people believe, and as the business scales, that will decline. And that's basically the thesis that I took into evaluation of Xero. And risk for me doing that valuation and thinking of it that way was basically, well, how good is the business? How high quality is the business? Can it retain its customers? Can it increase prices? And ultimately, where is it? The two variables that matter most to my model are the revenue per customer and how many customers they retain. Because if you can increase your revenue per customer, meaning that you have pricing power while retaining customers, you're going to end up in a situation where you have more revenue and more of it's falling straight to the bottom line because there's not as much getting eaten away with ongoing customer acquisition cost. An interesting note that you brought up before, and one thing I'll mention here, is that in a lot of these companies like to report, when they report SaaS metrics, they like to report annualized recurring revenue per user or annual recurring revenue per user, and they try and give you what is ARPU, like revenue per user, but that could actually be at a point in time, so June 30th or December 31st every year, whereas the metrics that you use in your model are typically lagging 1 year. And so you've got to understand that sometimes you're already working a year ahead of your model, and so the forecast is what's the end of next year looking like. And I think a few people miss that when they model, okay, I've got financials, but they aren't matching up with what management is saying, and that's because management is giving you the end of the year figure. Like if it's monthly annualized recurring revenue, it's that June period, typically when the users are highest. So I'm all aboard this train of thought, mate. When you break apart, and you've got a really neat chart on the 7Investing website where you break apart that sales and marketing. You could almost do it to an extent with R&D as well. How much of that R&D is truly recurring, and how much of it is growth focused. And I think if investors saw this, they would see, wow, these software companies are really impressive. One thing that we wanted to talk to today is that the discounted cash flow analysis as a whole, regardless of what kind of company you're doing it on, is quite sensitive. Sensitive to inflation, it's sensitive to discount rates, it's sensitive to this, that, and the other. I read something of yours on 7Investing where you talked about Zscaler, and you basically did a reverse DCF. So for people that aren't aware, and I'll share my screen again in just a second, for people that aren't aware, a reverse DCF is basically, instead of trying to set a price target or trying to say this is my intrinsic valuation, you try and solve it the other way. You set the intrinsic valuation at the share price today, and then you work backwards to say, well, what is the market assuming for this growth? So maybe I'll try and share my screen with you now, and I'll just bring this up because you've shared a very simple model, but it's quite, I guess, eloquent as well. So I'll bring this up here, and so people can see who are watching live. Let's bring this in. Let's hide this. So here we can see, and I'll make it a bit more obvious, we can see a very simple model that you've done, mate, for Zscaler, which basically has the future forecasted free cash flow, and then it's got discounted free cash flow. You've got a growth rate from years 1 to 10 of 40%. So this would be the free cash flow growth rate, terminal rate of 4%, and a discount rate of 11%. How do you then use this model to make sense of valuations in tech stocks?
Yeah, so I would say first you can change that growth rate for years 1 to 10 to say 34%. If you do that, then we will match up roughly with the share price, I think. Yes. Yeah.
Yep.
Okay. So, so what you did, for example, with the Xero model, that's a very detailed model where you're making assumptions about growth rate, cost of goods sold, how R&D is scaling. You basically are looking at the entire business. And I think it's a very useful exercise where you are trying in your head to figure out not just the economics of the business, but what are the levers that the business have, right? How and what happens when you're pulling those levers, and you're making, I guess, your average case estimate. And you can, of course, tweak the model to allow for different things to have a range of fair values, right? So you're trying to guess the future evolution of free cash flow. And because I'm not as smart as you are, mate, so what I do is I take the easy route. So I say, well, that's too hard. I can't figure that out. So now this only works if a business has some decent free cash flow being thrown currently. So Zscaler is a software company, a mid cap, large cap, you can call it, a mid capish in the US land. So what I do is I basically assume that there's going to be a constant growth rate for the first decade, starting now, and then after that decade, it's just going to be a terminal growth rate. And I've been using a discount rate of 11%, which basically means that if my share price, if my fair value is say $100 and my discount rate is 11%, then I'm basically assuming that I'm going to get 11% return. Right, that's a basic way, and then because I fixed the terminal growth rate at 4% and the discount rate, and you can vary these numbers based on your choice, but that's what I have done. I can then see, well, based on the input of the current free cash flow last 12 months, the cash and the debt. In this case, I've said cash is this and debt is this. Debt is zero, but it's actually they have like maybe 1.5 or 6 billion of cash, but they've got some convertible notes which I regard as debt. So subtracting it out, basically, I can say debt is zero and cash is 700 million. I look at the current shares out, or I look at sort of the estimated shares out at the end of the year, and then I look at the current share price being pulled in by the numbers tool, and then I just reverse compute, and basically reverse computing the growth rate. In this case, it tells me that the free cash flow needs to grow at roughly 34%. The market is basically saying, under these assumptions, free cash flow is going to grow at 34%. That's what's baked into the share price. Then I ask myself the question, do I think that's a reasonable estimate? Right? And the answer might be yes, in which case then you're looking at some roughly 11%, 10, 11% return. Or if the answer is no, then you're looking at a potentially much higher return. Now, in there too, I don't really try to be very precise. So I'm not a big fan of precision there. So what I say is that, look, this company grew recently sales by 60% plus, and it's actually been accelerating to some extent. These businesses sort of would have more operating leverage as they scale. So one would think that free cash flow overall should grow at a much faster pace than revenue growth for once they've scaled. So, it's very reasonable to assume that, maybe free cash flow actually grows at 40%, maybe even higher. And if you plug in something like 40% of that number, excuse me, then the share price is really, really undervalued, right? Then, of course, you can also ask yourself this question that, well, a company that grows at 30, 40% for the first, say, 10 years, is it all of a sudden going to grow at 5%? Probably not, right? So maybe the terminal growth rate is also very conservative. So, that basically tells you that I think right now the shares are very conservatively priced, in my opinion, is what my point is. And then if you look at the market opportunity, like the TAM, look at the current revenue run rate, current growth rate, their dollar-based net retention numbers, and how they're executing, you can see that, well, this business should keep growing. So there's many ways in which you can say that it's substantially to some extent you can say it's substantially undervalued. Maybe it's moderately undervalued, but it's definitely not, in my mind, it's not expensive. I will throw one last caveat, and this is an important one, I like this exercise for another reason. If you look at the year 10 free cash flow number, it's 3.4 billion. That's not a tiny free cash flow number, right? 3.4 billion free cash flow. If you assume that the free cash flow as a percentage of revenue is somewhere around 30%, then this business has to be generating $10 billion of revenue roughly, right? So if you're generating $10 billion of revenue, then you're going to get that much more of free cash flow at that time. That's, another way to think about this is no security company today has that kind of revenue, right? So you are thinking about these markets to be much, much larger than they currently are. And that's in a way, that's the risk, right? That's where the risk is. I'm not saying it's, there's no free lunch. So the risk is the market has to be large for it to generate that kind of revenue, which results in those free cash flow numbers, right? And I think at that case, it makes sense.
Yeah, I would probably, that's, if I was doing a model like this, and I occasionally do these, what I like to do is I like to have reference points for my future valuation. So let's, for example, say I'm just simply forecasting free cash flow as a single line item. I'm forecasting that into the future. Or at that end year, the terminal year where the terminal value starts to kick in, I want to have, I might even put in an exit multiple. So I might say a company that has grown this fast and it has achieved this amount of free cash flow might trade at 4 times free, five times free cash flow, 10 times free, I don't know, whatever the figure might be, 20 times free cash flow. And then I use that to get to an enterprise value at year 10. So rather than have like a terminal growth rate to say from year 10 onwards, it's going to grow at 4%, and I'm going to guess what that is. I'll say at year 10, I'm going to assume that I sell my shares at that point in time. So what would the valuation be at that point in time? And then I can kind of loop another valuation model into this one to say, okay, and now I can value it on earnings, or I can value it on my exit price, just like a private equity company would. I could say, I'm going to buy it at this price, which is a cash outflow. I'm going to sell it at this price in the future. And here's how that valuation is going to be made up. One thing that people might say, just especially the traditional value investors, they might say 34% to get to today's intrinsic value or today's stock price is quite a strong free cash flow. You've said, we're modeling free cash flow here, so we want to see the operating leverage. So this isn't revenue. Revenue might only go up at 10 or 20%, but it's the operating leverage that kicks in, which sees these types of companies achieve this. When you think about this 34% growth rate, would you think about it in terms of, say, what we spoke about earlier, where you have, in effect, dollar-based net retention of 125%, meaning that the existing customers are paying 25% more? Is that what brings you comfort to model these strong double-digit growth rates? Does that make sense? So, like, of the 34%,
Yes.
maybe 25% is coming from existing customers. So then it's
Exactly.
only really 9%, something like that.
Yeah, and that's why I said this is a very, it is mind-bending to assume that you can get that kind of free cash flow growth. But I mean, it's the operating leverage, right? I mean, if your revenue is growing at 60%, 70%, you could actually at some point be looking to grow that free cash flow at that similar number, right? And as you said, like if my dollar-based net retention is say 130% or 125%, and I get 25%. That's like gravy that's coming through, then I only need to generate a little bit more. So those are the ones that give you comfort. And I really like your point about this, looking at say year 10 or year 5 or whatever is your time frame, and then thinking about the multiple, right? And what is the multiple that people might be willing to pay if like if people are paying 20 times free cash flow, then this is like a 60-70 billion dollar company. If they're paying 30, it's more. If they're paying 10, it's only like 34-35 billion dollar. So there's a range of outcomes depending upon what people are willing to pay at that time for the free cash flow, and that tells you a little bit about whether or not you want to hold at that point. But yeah, the ability to the incremental dollar earned is basically almost free, right, from the existing customer base. So, and that's why I said this, the DBNR or the dollar-based net retention metric is really important because it also tells you about the staying part of the business, right? I mean, if you see deterioration in that metric, then that basically suggests something is not really working out well, right? The only reason to hold on to then at that point might be, at least in my mind, is, and I've made this mistake a number of times, is if the revenue growth is solid, but the dollar-based net retention rate is not, then it basically suggests that maybe they're landing much, much larger customers, and therefore the opportunity for the incremental extra sale is not there, right? But then you should be expecting to see that show up in stronger, remaining performance obligations numbers. So if the remaining performance obligation is growing at like 50%, but your retention rate is only growing at like 110%, that might be okay. What is not okay is that for both those metrics to actually be slowing down at the same time. That basically suggests that maybe competition is catching up to them, and So I made that mistake a couple of times, and sometimes being too patient is not necessarily a good thing. So there was a company called Alteryx on which, I made that mistake where the DBNR started falling, and then eventually the revenue growth rate started falling as well. Right. And then the other thing is the classic thing where companies sort of switch focus on the metrics, right? So if they've been focusing on
Yeah.
DBNR, and now all of a sudden they'll say, okay, let's not focus on that, but let's focus on the new annual recurring revenue added. The moment there's a new metric that shows up, well, you should be, there's a reason why the new metric is showing up, because it makes the company look good on that metric and maybe not as good on those previous metrics. And then at least I remember in one more case where a company actually dropped the DBNR chart. I think it was
Right. Altogether.
Alteryx. Yeah, so Alteryx actually dropped it. Should have been a big red flag in my mind, was, the chart has disappeared. It's still there in the press release, but the chart has disappeared because the chart makes it really obvious that it's declining, right? So, again, those sort of those sort of things. And it's, one would think that, I've been doing this for a while, that I would be, quick at. I did spot it. I did make the graph in my write up, but I still did not sell my shares. You see, so it's not that easy. I mean, you think, maybe it's okay. Sometimes patience might not be the right thing.
Well, it's kind of like a leading indicator in some senses, isn't it? It's not necessarily. I mean, you can't be too. I think you can't be too hard on yourself with these things, because it's like the old thing that management selling is a red flag, but there could be many reasons that a management team sells. And yeah, you might be right that they've sold because they think the share price is going down, but they could have sold for many other reasons. A tax liability, like a genuine tax liability. Maybe they have certain things going on in their life where they need to do that. And so there are many different flags that sometimes people look back in hindsight and say, oh, that was a red flag, but it was really amber at the time. It's like making the best decision that you can with the information that you have. Sometimes you don't have all the
That's right.
information. And so, I mean, that's going to happen from time to time. And what we've spoken about today is not necessarily, the solution to high growth investing. It doesn't work for every company. It doesn't work every time. And there's more
Yes.
to it than what we've talked about. And I think what they would pick up from this discussion is there's a lot of work that goes in before you get to your modeling. With these
Yes.
tech companies, you really have to understand the customer, the technology, the use case, the addressable market, how they're selling, why they're selling in a particular way. And you have to do all of that, and you have to judge all of that before you get to your modeling to then determine if your model's realistic or not. So I feel like this is a good kind of starting point for a lot of people that are new to tech investing, and how it may be different to, say, investing in Target or investing in a Tyre distributor or investing in whatever. And I feel like this was heaps of fun, mate. So we had a similar chat to this a couple of weeks ago for SelfWealth. But if people want to find out more about what you're doing, because you've done heaps of write-ups on this type of stuff, where can they go?
A lot of this stuff is actually available on the 7Investing.com website, and they're just under articles, so that that's not even behind a paywall. A lot of this stuff is just freely available to read. So you can just head to 7Investing.com, and you should be able to find, like this one, hidden profitability is actually freely available. You don't even need to log in to access it. So there's a bunch of things like this that I like writing about, that I've written, and yeah, again, I'll reiterate actually one thing that Owen, you said. I think that is actually really, really one of the things that people shouldn't think about. At least I would urge people to not think like that. Is there's no formula really, say that this formula, maybe when I was speaking, it might have come across as that there's a formula, and there isn't really a formula. There are a bunch of things that you can look at. And then you have to look at sort of the qualitative aspects, and you have to think about what the business is doing. And as Owen rightly said, I mean, the modeling sort of is maybe the last thing. We get to the modeling stage only when we sort of like the business, and we think that and it's doing the right things, and it's got a big market, and it's got the right leadership in place. And then sort of the modeling is sort of is a way to think about, well, is the price right? So I think that's probably the most important takeaway there. So I'll just reiterate what just Owen said.
Yep. Yeah, fantastic. And it's good to double click on that. But I guess I really wanted to have this conversation now because we're seeing some tech companies just being punished, absolutely smashed for what would seem like quite, I guess, decent results, maybe not great results, but decent results. And they're just They're just not good enough. And that's not to say that all tech companies are going to be in this bargain basement basket. It's just simply not going to be the case. But there are going to be some companies over the next 6 to 12 months, I think, that will present compelling opportunities for long-term investors. And you might not get every one of them right, but if you have the tools to look at them and to analyze them, it could be a good, fruitful time. So, mate, thanks for taking some time to join me. I'll put the links in the show notes to the articles that we referenced and also to your Twitter if people want to say g'day. So, Anirban Mahanti from 7Investing, thanks for joining me, mate.
Thanks for having me.